How to earn some money from home. For the first time in 50 years, the S&P 500 average dividend yield has risen above the 10-year Treasury note interest rate. Wednesday's close saw the bond yield jump slightly to 2.66% from an all-time low of 2.65%. However, the S&P yield is now 3.3%, creating an unusual spread of 0.64% in favor of equities. Historically, the two asset classes competed for investors' money, with bond interest beating stock dividends, resulting in an average spread between the two investment vehicles by an amount of 3.7 points in favor of bonds. So are stocks a better choice now? Well, they still generally are, but they are more volatile than they have been for a long time. When investors see substantial stock price swings, they expect the lack of stability to be offset by a greater dividend rate. This in turn pressures companies to increase their dividends. For the past half-century, stocks have enjoyed a steady rise in prices at a pace of about 7% annually, so there wasn't much need for a large dividend incentive. With bonds becoming more popular while investors flock to more secure investments, their interest rate has dipped, and conversely, stock dividend yields have now topped bond yields. Dividends along with bond interest can play an important role in planning for retirement, but a retirement savings program should not depend completely on this income. Market forces such as the current recession can alter companies' dividend allocation. Although 212 companies have increased their dividends this year, tight credit markets have forced businesses to retain $648 billion in earnings, and 41 companies, including 35 financials, have cut a record $37.9 billion in dividend payouts. Thus, there is no guarantee that stockholders will see dividend yields shooting up anytime soon. In fact, analysts expect fourth-quarter dividend payments to decline by 10% from 4Q 2007, the worst year-over-year slide since, interestingly, 1958.